Good afternoon and welcome to the ENS Africa Budget webinar. We're very pleased to welcome you this afternoon to our panel discussion about the announcements that were made by the Minister of Finance in the Cape Town City Hall this afternoon. We've had a little bit of time to analyze the budget and to look at the details of the that's set out in the budget review, and try and give you some of the information that maybe hasn't hit the headline issues yet. Something that I've been tracking for a number of years is the number of words that the Minister of Finance uses in his budget speech. And if you're interested, this year he used 4,820 words, which is a whole 403 words more than he used last year. And we'll kind of get into the detail of how successful he was in conveying the message. But it was certainly a lot shorter than Minister Godongwana's message when he was Minister of Finance, when he used to use in excess of 9,000 words to convey. I think what it was in some instances a more complex message than was conveyed this afternoon. We're joined this afternoon by Iraj Abedian to specifically give us a economic perspective. Iraj is the founder and chief executive of the Pan-African Investment and Research Services. When he's very involved in policy development and has served on the Presidential Economic Advisory Panel as well. And you all know him as a well-requested, respected economist who says it the way that it is. And Iraj, we're very happy to have you on our panel this afternoon as well. The ENS participants are Mansour Parker. Mansour specializes in corporate tax, energy tax that is critical this afternoon, sports tax and international tax. He's got more than 20 years of consulting experience, and I know that he's done a lot of reading this afternoon to get into the nitty-gritty of Annexure C. The other person on the panel is Jenny Klein. Now, Jenny specifically specializes in the employees tax, individual tax and international tax matters for individuals, specifically in respect of inbound and outbound assignments. A number of people sort of watch the budget in terms of announcements for reduction in tax rates and fiscal drag, etc. And Jenny will get into some of the detail of that as well. My name is Charles de Wet, and I'll be trying to ask the difficult questions this afternoon so that we can really unpack the budget in much detail as we can in the time that we have available. If we sort of start off in terms of overall impressions of it, I think that what we saw was a very measured tone. It sounded a little bit like what the budgets have sounded like in the past. No really major announcements, no big tax announcements in the circumstances. So hopefully no shocks to the market or the rand. But if you dig down into some of the detail, then maybe it's not as clear cut and maybe not as positive as it appears at first glance. Iraj, from an economic perspective, would you agree that there's some of the devil is in the detail?
Absolutely. If it ever was true that the devil is in the detail, this year's budget is exactly that. And this budget obviously dealt with the much anticipated Eskom problem, or broadly energy problem. That's really the sort of good news in it. Good being, definition of good being, getting the ambiguity out of the way, dealing with the issue. For 5 years, we've been, capital markets have been particularly nervous about what's going to happen to this 400 and rising billion debt on the balance sheet of Eskom, and what does it do to their bonds that they hold. So at least this time, the government took a massive, bold, and possibly foolish. We'll see, time will tell in the next few years whether it was bold or whether it turned out to be foolish to take 60-odd%, 67% straight away over the next 3 years. and potentially take on another 20 to 25 billion, which is municipal debt owed to ESCOM, because that floodgate has just opened. And that was the good thing, removing this uncertainty for the capital markets. For economic growth, their economic growth projections in this budget speech, in my view, is optimistic, because it doesn't take account of the almost inevitable gray listing that is going to come upon us in the next week or so. And that will take anything from 3 to 7 years to rectify, with huge cost to the economy, and a cut to the GDP. The third issue that we can come back to it, of course, is potentially a very good one, is transition to more solar panel rollout for households and for the businesses. My concern and my fear has come to pass. It is terribly, terribly poor reach. The poor gets completely sidelined and excluded from this subsidy, simply because they don't have a tax facility or they don't qualify. We can come back to the details. There are some really rookie errors, economics 101 errors here in this framework for rollout, by giving only 12 months to the households to do it. The supply demand means the price is going to go up, not more rollout. Bottlenecks are going to build up, not a transition to more sustainable and environmentally clean energy. The fourth area I'd like to touch on is the budget left some big issues unresolved. The biggest elephant in budgetary allocation with the political and social implications is the public service wage bill. There has been 2-3 years of wrangling going on, and yet today the minister said, no, it's not resolved, so I'm not budgeting for it. I don't know whether I'll budget 5%, 6%, a 3% is penciled in, but we know the unions are going to absolutely under no conditions take it on. And the final issue, which I would at macro level touch on, and we can come back to it, is despite all the promises by 3 ministers of finance that SOEs will not be subsidized ever again, SAA was given another billion, and the post office was given, and the others are not disclosed. So I think that is at the expense of not focusing on the infrastructure growth. Our growth has been underpinned by our exports, commodity prices, and yet we all know that our infrastructure for export and for foreign trade, be it in the form of rail capacity, be it in the form of port capacity or port management, or for that matter, crime fighting infrastructure, organized crime particularly, it's just not up to standard, and that will undermine our growth. So these are the key observations I make about this budget. Is it more of the same? In some areas, not. In some other areas, more of the same, in the sense that making the same basic errors of macroeconomic management. Thank you.
Thank you, Iraj. And can I ask you if you have any questions that you would like to put to the panelists? If you could do that using the Q&A box, then we'll try and address as many of them as we possibly can during part of the discussion. Iraj, I mean, just sticking with you for a moment. I mean, at the risk of being critical of the budget process, you mentioned the point about the grey listing, and I mean, I think they're meeting on Friday and we'll have sense of that. But doesn't that mean that from an economics perspective, the economic growth that they've projected, all the numbers are potentially wrong as far as that's concerned? So we're starting off at almost on a not very firm footing as far as that's concerned.
Absolutely. As I mentioned to it, the mistake for me from an even political pronouncement point of view, never mind from a technical projection and econometric calculation point of view, is that if you know that there is a high probability of grey listing with a massive knock on your GDP because it raises the cost of capital and constrains access to a lot of capital in many areas, you need to have basically 2 columns. It says this is if nothing happens, is what has given us. But if it's going to happen, the growth could be dramatically lower. And that means your deficit GDP ratio is going to be much higher. It's not going to be in the region of 4% or 3.3%. It's going to be substantially higher. So I think those are some of the details, and that is where the devil lies.
Mansour, probably the biggest announcement was, I mean, in respect of renewable energy for businesses. Your impressions of the minister's speech this afternoon? You're still on mute, Mansour.
Okay, is that better?
That's perfect. Thank you.
Okay, thank you very much. So the proposal that was made in this afternoon's budget is that the concession for investment in renewable energy will be improved. Companies who invest in renewable energy, not simply solar, it's all forms of renewable energy, whether it's wind, concentrated solar, hydropower, regardless of thresholds, will be entitled to claim 125% deduction for that investment in the first year. And that concession will come into operation from 1 March 2023, next month, and will run for the next 2 years until 28 February 2025. Now, what's important about the concession is that it is targeted at those who own the renewable energy equipment. Now, there are many taxpayers who may decide not to buy it. They may decide to enter into power purchase agreements with independent power producers and procure the electricity in that way, as opposed to them doing a self-build of these projects and having them on their balance sheets. Now, this concession is also relevant for that grouping of companies, because if you're a company and you're buying the renewable energy assets, you got to pay attention to the amount of the deduction that you can claim and in which year you can claim it. But if you're a company which enters into a power purchase agreement, a PPA, with an IPP, and they charge you a tariff, that IPP will determine the tariff, the electricity tariff, based on their costs. So in their financial model, they should make provision for this enhanced deduction. So companies who are engaging with those entities on the PPA should check the financial model and see that the cost is being determined with regard to this higher rate of deduction, 125%, and not the older rate of deduction, the 100% over 1 year or the 50-30-20 over 3 years. So that will be a very important point so regardless of which side of the divide you sit on, the concession is equally important. And something which is a more subtle issue, it doesn't come through in the budget announcements because it's not a change in tax law, but it's going to become increasingly important, is the ownership of the environmental attributes associated with renewable energy projects. Whether they qualify for carbon credits or renewable energy certificates, they're two different types of certificates that become increasingly valuable. Entities who are looking into getting into renewable energy should do an upfront assessment on whether they qualify to get those credits, whether it's the REC, the renewable energy credit, or renewable energy certificate, or the carbon credit, and make sure that the agreements places ownership of those credits in the correct box. The other amendments were more granular amendments in Annex C, but I think we can touch upon those in the course of our discussion this afternoon, Charles.
Yeah, thanks, man. So we'll get into a little bit more detail as far as that's concerned. Jenny, I mean, as far as the individual is concerned, I mean, for those of us that are old enough to remember this, Minister Manuel always used to make a big deal about how much money he was saving taxpayers. I mean, this year it's about 15.6 billion rand. That really looks like a big number, but the inflation rate is 4.9%, which is an interesting rate. I mean, do you think that we've been misled as far as that's concerned? And some comments about, I mean, overall impressions, but also solar for households or rooftop solar that it's being called.
Thanks, Charles. Yes, I think the point about the inflation rate adjustment that has been used to adjust the personal income tax brackets, the medical tax credits, the tax rebates is 4.9%, as you said. But the Stats SA official inflation figures as of January 2023 record inflation on an annual basis at 6.9%. So I think that the 4.9% is referring possibly to the core inflation figure, which excludes what is has most impact on individuals, which is food and energy and non-alcoholic drinks. So I think that the adjustment is a partial adjustment for inflation rather than a full adjustment that covers or that provides relief for individual taxpayers in terms of their personal tax rates. I think, as you mentioned, the main announcement that impacts on individuals, apart from the adjustments to the tax brackets, is the announcement of the solar rooftop panel tax incentive, which we will get into in a bit more detail. But I think it's important to say at this point that incentive, although it will be welcomed by many people, is actually fairly limited, as Iraj pointed out. So it is quite restrictive and it's fairly limited, but it will be of assistance to many people. I think the other point that I want to mention is that there's been a 10% upward adjustment in the tax brackets that apply to retirement fund lump sum benefits. So there are two tables that apply, separate tables of tax rates. One applies to a lump sum benefit when a person retires from a fund, and the other one applies to withdrawal benefits. And both of those tables, the brackets have been adjusted, so the tax rates have remained the same, but the brackets have been adjusted by 10%, which is appropriate given that they haven't been adjusted for a number of years. The other point that has been confirmed in this budget is that the two-part retirement system, which was proposed in the course of last year, there was some draft legislation, and it has been confirmed in the budget that will be implemented with effect from the 1st of March 2024. So I think this year what we're likely to see is some clarity on exactly how those provisions are going to work, because there were a number of policy issues that were not settled in the course of last year. So it will be good to see some clarity on those proposals. And what it aims to achieve, of course, is to give people some access to their existing retirement savings, to a portion of them at any rate. So those are the main announcements that affect individuals. Thanks, Charles.
Thank you, Jenny. But I think we've now managed to sort of summarize the crux of the budget in about 15 minutes. So we could have done it shorter than the minister did in the circumstances. The only aspects that we haven't mentioned yet was when excise went up by the strange core inflation rate of 4.9%. I mean, the same as the reduction in the fiscal drag adjustment, and there was no sugar tax change and nothing. I mean, as far as the fuel levy and road accident fund is concerned. So those are sort of the headline tax issues, and we could probably close this down, except if Iraj, want to talk a little bit more about sort of the expenditure side of things and the priorities that have been identified, and whether that sort of supports the broader message, or whether we're already starting to see sort of serious electioneering coming out of it in terms of the language that is being projected.
Look, fiscal policy, if it's not political, then it's useless. By definition, governments have to have an eye, a very serious eye on their electoral support. So that's why you see in this budget a very sort of spelled out how many bridges in which provinces the government is going to build and how much has been allocated to that. And there is a hospital in Limpopo. So all of these are spelled out in electioneering mode, and there's nothing wrong with it as long as they deliver on it. It's good. So there is a fair dose of that. The emphasis on welfare payments is another electioneering thing. How many people are going to get, and 60% of the budget is going to go to social wage. So these are obviously, and as I emphasize, budget is not a corporate affair, it's a political economy affair. It's got to strike a balance between the welfare side as well as the economic side. Where we have a problem, or I have a problem, is that there is very little attention to the medium-term growth stuff. There is very little investment allocation for what makes this economy grow. I mentioned our rail is neglected for decades. Our ports, Minister Godongwana is on record to say it requires 150 or 185 billion rand of investment. There is not a single mention of it. Our crime fighting, which is important for our social welfare as well as for our economic growth, is allocated only 100 million. 100 million for organized crime. It's just peanuts. So stuff like that are problematic. It's that, in other words, there isn't a balance between the politics and the economics of it. It's way too tilted in favor of politics and too little in economics. Charles, if I may use this opportunity, a question that one of the participants, Wilhelm, raises, which is a very important point in this context of our discussion. I earlier mentioned that maybe the taking on of 70% of ESCOM debt may turn out to be foolish, maybe brave. The question is, why is it foolish? Because it doesn't affect the government credit rating. It doesn't, absolutely correct. From a sovereign rating point of view, it makes no difference. However, from a moral hazard of corporate management, it makes all the difference, because now that ESCOM has learned that if you drag it on and you keep the country hostage, you can get the government to take it off your balance. Watch this space. Next time is going to be PRASA. Next time could be could be Transnet. Where do you end? Because you've sent a message that mismanagement, poor management, but whether it's political mismanagement or technical mismanagement, corruption, whatever, that hollows out an organization like ESCOM and Transnet and so on. When it gets big enough, government has a problem, not that corporation. Just make a mess big enough so that it becomes a country problem. Government will take it off your balance sheet, and nobody will go to jail. Nobody will be gray listed except the nation. That is the foolish part of it. It's a very serious fiscal management principle that in fiscal allocation, in rescuing organization, you do not do this type of takeover without visible, and I mean visible, politicians and technicians, CEOs, suppliers, etc., wearing the overall. Look at what Brazilians did and other countries. So Operation Car Wash in Brazil was exactly meant to deal with this issue. People were showcased with their overalls, ministers, heads of departments, CEOs. And here we get nothing. We get the backdoor negotiations, conditions are not known, and nobody is named and shamed and put to jail before this amount is taken on board. And that is a problem. That's why I mentioned the term foolish.
I mean, one of the things that we've always, sort of acknowledged over time is that National Treasury has been the star in the in government. They've always done their job. They've stood firm when they've needed to do that. For a number of years, SARS was in that position as well, from a collections perspective. But what we know about SARS is that there was a significant skills loss. Senior people that understood the business. If you look at this, and you've referred to the economics 101 in terms of the technicality of, we expect a very high quality product on budget day. In terms of detail, in terms of the numbers, we know that ministers spend from Friday afternoon rehearsing their speech in the circumstances, and it seems to an extent that this year we were not quite there. Is that because of a sort of a brain drain, a lack of skills at that level, a lack of capacity there that we're seeing coming through? And will this have a longer impact? Has it got a tail that will affect us in future, especially given the prospect of grey listing as well?
Yeah, I have no doubt that there has been a loss of technical capability as well as technical integrity. And by that, I mean the interaction that has to take place between the office of the minister as well as National Treasury. And those losses of technical capability are quite visible. If you read the text of the budget speech itself, you can see the substance of fiscal jargon, fiscal expressions, and the way of integrating different parts of the speech don't come through at all. And that means that those who were writing these speeches, they had one mission in life, make this as simple as possible so that everybody can understand. But then the compromise is, well, the capital market is not happy because the different segments of the budget are not integrated. And that's where we can see the loss of fiscal expertise, so to speak, in communicating with the capital market as well as communicating with the citizen in a balanced way. We've swung one way because we've lost capability on the technical side.
And so we've had a question around sort of, the reduction in the tax rate and so on, and I'd like to get to that. But, from a tax perspective, I mean, in terms of sort of that lack of skills, I mean, maybe at National Treasury level, an exercise is quite detailed on really technical stuff that one has to work out exactly what they're talking about. Sort of what point is being raised, and it seems to be very much focused on abuse or perceived abuse in the circumstances. Do you think that from a tax perspective we're seeing the same kind of thing?
Yeah, Charles, thanks a lot, and thank you for alerting me to the question in the chat box, and maybe I could just deal with that one very quickly. That the question was 27% corporate tax is now gazetted, but why not announce in the speech? Because it was announced last year in last year's budget speech, and the having come into effect, the budget speech is normally used as a precursor for the changes to be made this year. So there's a brief announcement in the budget, followed by the Taxation Laws Amendment Bill, which will be released later on in this year, which contains the detail. So the budget is like the skeleton, and the meat on the bones will be added on by the TLAPs. There's no further need to make another announcement on that corporate tax rate change because it was announced previously. On the Annex C, which contains the more granular amendments, I thought I could just mention some of the...
Can I stop you there? Just, sure. I mean, while we're talking about tax rates, I mean, we did kind of see almost a commitment to reduce the tax rates over time. When that announcement was made, and we in global terms we are still, I mean, quite high. I think the average global rate is sitting around 23%, and that was almost noticeably missing this year. I mean, at least a further commitment to a reduction in a year or two. I mean, we know that they try to balance the books in terms of reducing deductions or carrying sort of carry forward from a cash tax perspective, but nothing like that. I mean, shouldn't we have expected something like that as well?
Look, the way I would read it is that in the previous budget, an announcement was made that the SA tax rate is generally higher than the OECD global corporate tax rate for our trading partners. So I think that commitment was made there, that there needs to be a narrowing of that gap. And I didn't see a withdrawal of that commitment in this year's budget. So I would say that if that point was made in the previous year's budget, then that commitment still stands to reducing that gap. And the fact that there were no rate announcements made this year, I don't think it nullifies that commitment, but that we should still hold government and National Treasury to that previous commitment, that it does need to be this narrowing of our corporate income tax rate versus those of our trading partners.
Sorry, I interrupted your point about the skill level of an HSE.
And I was going to say, before I get to Annex C, that there were a few other points in Chapter 4 of the budget. Chapter 4 contains the main tax policy proposals. I thought I'd just deal with them very briefly. One is the extension of the UDZ, the Urban Development Zone tax incentive. So those looking at buying properties within UDZs, you now have a further 2 years until 31 March 2025 to do so. The second is the announcement of a draft position paper that will be circulated for public comment on the two-pillar solution, which is basically the approach that global companies should be taxed at an effective tax rate of at least 15%, regardless of where they are headquartered or in which jurisdictions they operate. So that position paper will be released this year for public comment, and draft legislation will be prepared for inclusion in the 2024 Taxation Laws Amendment Bill. And the last of the ones at which I wish to touch upon in the Chapter 4 is the R&D incentive, which has been extended for 10 years. And it's run somewhat counter to the recent trend where we've seen tax incentives being allowed to expire when they reach their sunset date. So this shows that properly motivated incentives will be allowed to continue. but that one shouldn't take that for granted. With regard to the Annex C process, Annex C does contain a number of proposed amendments. The one which I think which caught my eye immediately was the note in respect to Practice Note 31. Now, Practice Note 31 is a note which allows a taxpayer a deduction of interest in circumstances where the taxpayer is not a money lender and does not carry on a trade. And we saw many companies involved in securitization transactions, group treasury companies involved in BE transactions making use of Practice Note 31 in order to claim the interest deduction on monies which they borrowed in order to unlend. An announcement was made of the pending withdrawal of the Practice Note, and comments were invited. After receiving those comments, government said that they will delay the withdrawal of the Practice Note. That's good news. Introduce specific amendments into tax legislation and then match the withdrawal of the Practice Note with the effective date of those tax amendments. So the idea is to have more targeted measures to deal with any abuse of this interest rate deduction, as opposed to a wholesale withdrawal of the Practice Note. So what we will see in future is a withdrawal of Practice Note, at the same time, introduction into tax law of specific provisions, and that will be dictated by the further process the government will undertake to consider the impact of the withdrawal. And we were involved in making submissions to National Treasury on this very point, and pointing out that legitimate businesses could be impacted by the withdrawal of Practice Note 31. The rest of Annex C contains proposals with regard to corporate income tax, international tax. Lots of the proposals are described as clarifications or refinements of existing positions. One of the key points that we saw emerging is the clarification of the foreign business establishment exemption for controlled foreign companies. And this is a point where you and I, Charles, had discussed before, and that we had the Coronation Fund Management judgment, a very important judgment dealing with offshore operations and the outsourcing model that certain companies follow, and the position that SARS took, and the judgment that the SCA took in this matter. And what this proposal seeks to do is and in this budget Annex C document, it's drafted in very general terms. So the meat will be contained in the taxation laws amendment bill. But what the proposal aims to do is to clarify tax legislation so that a controlled foreign companies, foreign business establishment, all important functions for which the CFC is compensated needs to be performed by that CFC or another company in that jurisdiction where the CFC operates, and that the outsourcing model wouldn't be compatible with this approach. So I think many companies who have CFCs with an outsourcing model should review their positions in light of the Coronation Fund judgment, as well as the intended tax changes contained in Annex C.
So I mean, that judgment in the Supreme Court of Appeal, that's only a couple of weeks old. And I mean, sort of reading between the lines, it's almost as if they want to codify the judgment in the circumstances, which is presumably bad news for, international expansion and sort of current structures that are in place. I mean, is there something that is going to be sort of top of mind this year, something that we're going to have to fight very hard about in terms of the submissions on the draft laws amendment bill?
Yeah, absolutely. And we see it happening here for those submissions, as well as other areas contained in Annex C, such as the taxation of non-resident beneficiaries of South African trusts, where we had this mismatch between the income tax gain, the income gain, and the capital gain, where the income gain could be distributed to resident and non-resident beneficiaries under 25B of the Income Tax Act. But the capital gain had to be taxed in the trust first before it could get distributed to the non-resident beneficiary. And there's a legislative amendment proposed to align those two, to make paragraph, to bring 25B more in line with paragraph 80, which would mean the income gain to resident beneficiaries is taxed in the hands of the resident beneficiary, but the income gain to non-resident beneficiaries is first taxed before it's distributed. So from a submission point of view, I think it's very important, because because we had the Thistle judgment in the context of trust, we had the Coronation judgment in the context of CFCs, and now we have the Annex C proposals tightening those positions in respect of those sections. So I would agree that the need for detailed submissions is quite high.
Jenny, Mansoor spoke about Practice Note 31 that I think was introduced in 1994 that suddenly disappeared without notice in November and has now been reinstated. What certainly never caught my attention was, Practice Note, was it 37? That now, there've been some developments on that are worthwhile talking about as well.
Yeah, you're right, Charles. So Practice Note 37 was a practice note that many individual taxpayers used because it provided for a tax deduction for the tax return completion fees charged by accountants. In other words, whoever you use to complete your tax returns, that those fees were deductible under that practice note. And it was announced that Practice Note 37 would also be withdrawn in the same announcement that dealt with Practice Note 31. So what Mansoor mentioned earlier in the context of Practice Note 31 applies equally in terms of Practice Note 37. In other words, that the withdrawal of that practice note has been put on hold until the relevant legislative amendments can be made. And the issue here with Practice Note 37 seems to be to include the concept of what is a registered tax practitioner under the Tax Administration Act, and that needs to be aligned with the deduction that's available under Practice Note 31. But it is obviously welcome that practice note is still in place for now. And then, as Mansoor mentioned, once the tax amendments have been implemented, then one would imagine that Practice Note 37 will also be withdrawn along those lines.
I wanted to stick with the point in terms of, kind of the skill level and what you're reading into the detail of the proposed changes. We saw, and you've made this point already, we saw last year about home working and office working and, changes in that space. We've seen the two-pot system that has kind of been pushed out, but he's still there. What is your sense in terms of kind of that level of detail? I know also that there are a lot of other technical and almost that look like anti-avoidance provisions in the legislation as well. What are you reading into that from an individual perspective?
Yeah, it's an interesting question, Charles. I think when we looked at the two-pot retirement system, the draft legislation that was issued last year, it became apparent that there were quite a number of policy issues that were not clarified or dealt with adequately in the draft legislation. So in the process of giving public comments, there were a lot of public comments on issues that hadn't yet been decided or that weren't clear from what in terms of what was proposed. And 4 of those issues are actually still outstanding. And largely because of the public comments received last year, the draft legislation was put on hold for another year. So it's expected that it will only happen in the course of this year. And the main issues that at that point were still to be clarified was the extent to which people could access their existing retirement savings. So in other words, whether you could apply what they call seed capital and have access to that. The other big issue, which wasn't fully canvassed last year, was the impact of these proposals on and how it would apply to defined benefit funds. And that is also something that had to be considered by National Treasury. And the third point that they say is still outstanding is what happens to legacy retirement annuity funds and how do these rules apply to them. So I think that what you can take away from that is that the retirement fund space is very complicated. And I think that there were some significant gaps in the proposed legislation last year. And I think there's had to be a bit of thought gone into how these proposals will apply in terms of those particular issues. And I think the other thing that we noticed was that the drafting needed work. The draft proposals were not necessarily, entirely adequate for what was being intended. So I think if you look at that as an example, for there was draft legislation, I think that it's fair to say, was issued before there was a full grasp of what all the issues might be. And I think, and it's needed significant work, but has actually, that's what happened. So those proposals were withdrawn, and now we'll get another look at a new set of draft legislation, which I think is a good thing. So that's what we've been seeing. And I think Mansour mentioned a number of technical proposals in Annexure C. And I think what's sometimes difficult is to understand the full impact of what those proposals are going to look like, because you get very little detail in the document of, in the budget review. So it does become a bit difficult to understand fully what these things might mean. So I think there is room for public comment on these types of amendments. As you said, Charles, detailed submissions on the Annexure C proposals is an important step in the process.
Jenny, I want to go back to the rooftop solar for individuals, because I think that the impact of that, it's going to cost 4 billion, and we'll talk about the economic implications of that as well. But there's some quite stringent limitations that exist as far as that's concerned. It's only for 1 year, so it's like a special arrangement, maybe, so that to help with load shedding. So whoever installed their panels today doesn't qualify. You must have waited until next week. It looks like a deduction against your income. So the saving is only about 6,700 rand if you spend the full 60,000 rand, and that gives you 18 panels in the circumstances. Maybe I've added too much detail now, but can you maybe expand on that, and whether what you think the impact of that is? I think we already made the point. It's very much focused on the taxpayer base. The relief is not big enough for people to put to buy a couple of panels and put it up. But do you think that this is going to change the landscape at all?
Well, that's the question. It will definitely change the landscape, but whether it's going to be sufficient to address the challenges is another question. I think what's important to note here is that this tax relief only applies to the solar panels themselves that are installed at a private residence. So it will not be available in respect of any of the related or associated costs. So it doesn't apply to batteries or inverters or the brackets that the panels are installed on, or the cables, or the installation costs. And it also is not applicable to generators, for example, that was specifically mentioned in the budget. And they've issued a set of frequently asked questions on this. So there is some detail in there, which is more detail than one would normally see in the budget review. And I think the reason for that is that people then need to understand how this is all going to work, because the tax provisions themselves are only going to be legislated later in the year. So I think it's limited in terms of what it covers. And if you're going to follow the rental option, there's not going to be a deduction for you for that. And as you mentioned, the deduction is limited to 15,000 Rand, and it's also per taxpayer, per individual, and it's also limited only for the 2024 tax year. So it's going to create, a lot of demand for solar panels potentially in a very short space of time. So those are some of the limitations. And the other point to note is that if you are a subject to PAYE, you're only going to be able to claim your tax deduction on assessment of your tax return, which creates a bit of a time lag in terms of when you can, when you have to outlay the expense and when you can get a deduction. But I think the main point is that it is limited in the taxpayers to whom it can apply, and the amount is also limited. But hopefully it will encourage some people to make use of it. But I think that there are significant limitations there that we need to be aware of.
Iraj, from an economic perspective, I mean, a short period, I mean, aren't we just taking 4 billion rand and giving that to solar panel installers, and they're going to become the richest people in the country in the next 12 months?
And also the importers of solar panels, because we are not really a manufacturer in a big way. So we're going to import a whole lot of them. And the installers are going to take a position and now aggressively market it to use it. And very importantly, if it doesn't apply to the other associated batteries and inverters and so on, that in itself going to have substantially less economic impact than otherwise it would have had in terms of relieving the system from an energy demand point of view, because it will only be usable in very limited ways. So I think that's why earlier on I said I'm just absolutely shocked of the rookie errors in terms of, even when you want to do a good policy, you completely destroy it through the implementation regulation of restrictions. There would have been much better models, as they've done in some other countries, to go the route of asset finance and give it a 5-year period, and really get the momentum for economic impact going. Of course, the only positive, a little bit of ray of hope, is that some big businesses who've got no limitation on that, they can start having independent power producer operations. Because the tax incentive is fairly rewarding, 25% over what it costs them. They've got more time and they've got a tax base. So I think that's the only hope. From a household point of view, is really bad news. From a distribution of income and from a social impact point of view, is really a rookie error, second to none.
I mean, one of the things that we, thought about, and when the president started mentioning this, he almost mentioned bounce back loans, that came out of the COVID era. There was almost an anticipation that it could have been done over 5 years. They could have helped people to finance it at a favorable interest rate, and that could have generated the momentum that we needed, both to get rid of load shedding and to develop economic growth. Wouldn't that have been a much better option?
Absolutely, and that is where the working class could suddenly use it, because they could pay it off over 5 years, like a vehicle that they pay, like a fridge that they pay, whatever. And the banks and the asset financing institutions would have the ingenuity to come up with all kinds of schemes to make the outreach as wide as possible. But giving it in a very limited, narrow way is very problematic, and unfortunately with very little expected positive economic impact on job creation, on social development.
Thank you, Iraj. I'm going to, Jenny, come back to you. There's a question as to whether that amount is a deduction or a rebate, and I got confused reading reading the budget review. So maybe you can comment on that. But Iraj, we also had a question about the kind of the social relief and the extension of that, and whether that was almost expected. I think it was promised, but the numbers are maybe lower than we thought. I mean, what is your sense of that, and do we ever get out of this trap that we've dug ourselves into?
No, thanks to COVID, not just the South African government, many governments are now under pressure to convert the COVID-induced social relief, a monthly social relief of distress, to some kind of basic income grant. However you want to toss and turn it, I'm prepared to bet that no government will be able in South Africa to get rid of this social relief monthly. 12 million have applied, on top of already nearly 20 million beneficiaries of welfare, and that shows the extent of desperation out there. And that comes back to my previous point, that this budget had an opportunity to say, we are under this pressure, we have to turn the economy around. We got to invest in getting the economic underpinning so that in 2 years' time, we can get rid of the social relief liability. And yet, none of that. And unless you get the economy turning around and generating jobs and revenue, there is no way that any government can now suddenly cut off the monthly social relief of even 350, but 8 to 11 million people are receiving it. You can't get rid of it. We have created this sort of social pressure or political pressure interest group who are real, and desperation and poverty is real. It's not imaginary. It's not a short-term thing, and no government will be able to get rid of it. So I'm not surprised that they extended it. And from my side, I expect it to become a part and parcel of our fiscal policy going forward, but not in the form of social distress, but in a kind of basic income grant.
Thanks, Iraj. Jenny, is the solar, is it a deduction or a rebate? Have you said there's another document that has already been published. Does that clarify it?
It is referred to as a rebate, Charles. It's a tax rebate, a maximum of 15,000 Rand for the year. So that's quite correct. The comment is quite correct. It's not a deduction. It's actually a tax rebate.
So the saving is 15,000 per individual and not 6,000.
Times your marginal rate. Agreed.
Yeah. Mansoor, from, I mean, the 125%, I mean, that is a deduction that people would be entitled to. So there's no confusion about that in the, I mean, from a corporate perspective at all.
Correct. That would reduce the taxpayers' income, and then would result in less a taxable income. But it's not a rand for rand credit against the tax liability. It's a reduction against the taxpayers' income. And perhaps what I could also touch on now, we said Annex C has got all the granular detail of the specific amendments, and there's quite a bit written about a proposed amendment to the contributed tax capital definition. And that's something where there's been a lot of tinkering around with it over the past few years. And CTC is often favored by foreign shareholders of South African companies because the return of CTC to a shareholder, and CTC is basically the equity contribution by the shareholder for the issue of shares. But the return of CTC by a South African company to a foreign shareholder can escape tax in South Africa, A, because it's not a dividend, so therefore dividends tax is not payable, and B, if the foreign shareholder doesn't have a nexus, connection with South Africa, and the SA company doesn't have a big stake in immovable property, then you can have a tax-free return of CTC. And what the Annex C noted is that there was certain tax structuring that was done where you'd have a multi-tier corporate structure, 2 foreign companies, 1 SA company, and the intermediate company is the tax residency is changed to be a South African company. So now it's shifted from 1 foreign holding company to the intermediate SA company, and then the operating company. The operating company distributes a dividend to the intermediate company, which is now South African, therefore no dividends tax payable. When the intermediate company, which was a foreign company, becomes an SA company, then the CTC is considered to be the value of the shares in that company, which then gives it an amount of CTC which it can distribute to its foreign ultimate holding company. So what Annex C announced is that there will be some proposals in the pipeline to deal with that type of scenario. And there was also one paragraph statement on crypto assets, that there's a National Treasury will be looking at ways to make the monitoring and reporting of crypto asset transactions to be more in line with the applicable exchange control regulations.
I mean, one of the things, Jenny, that we talk about often, I mean, sort of around related is around loop structures and ex-con changes, and there've been some developments on that in the last little while. Have you seen any developments, any announcements this afternoon that impact on that structure?
No, there wasn't anything apart from the comment that Mansoor has just alluded to. There weren't any comments regarding exchange controls. So I'm not aware of anything anything new as of today.
I mean, one of the things that we sort of haven't mentioned at all, and because it's my favorite topic, is around VAT. So let me just tell you very quickly about the VAT changes. They were also, very technical of nature, sort of stuff in the short-term insurance industry, in the mobile industry around vouchers specifically, issues about gold exports, and then also on residential housing, and then probably the most cryptic thing was some sort of revamp around the VAT administration system. sort of my understanding currently is it works better than the income tax one and the PAYE one that keeps on changing the balances, but also, sort of nothing major as that, just a lot of cryptic detail as far as that's concerned. We're running out of time quite quickly, so I'd like to sort of get into conclusion mode. Iraj, any final comments? Are you still excited about this? Are you going to be broadcasting a positive message, or have we got a good sense of realism in terms of where we are now?
I think we need to be realistic. It's a tough environment, both politically and from a technical point of view. The government hasn't got the capacity, and the economy is under stress, and the Minister of Finance got limited resources. So that is true. I'm a bit disappointed that in this environment, as they say, when the going gets tough, the toughness gets going. We need ingenuity, we need creativity in fiscal use of our resources. And I unfortunately didn't see any of that in this budget. So we're going to, on my part, I'm going to keep raising it. And we need to engage the fiscal authorities from Minister to National Treasury to deal with these issues, because they are not going to self-correct. The social pressure is important. Engagement with policymakers is absolutely critical.
Mansoor, maybe a final comment from you. We did very detailed submissions last year to National Treasury. We spent hours and days in workshops with them in terms of telling them what needed to be fixed in the tax system. Not a lot of that. How are you still bullish about this afternoon, or where's your head at the moment?
No, it's an ongoing process, and I can see it happening again, unfolding again in that way this year. Because if you look at the proposals, the tax rate is left unchanged, but the proposals are all looking at expanding the tax base through the removal or the limitation of whether it's interest deductions under 23M, whether it's distributions to non-resident beneficiaries, whether it's foreign business establishments. So those detailed rules is being tightened, thereby expanding the base. And what we always need to be on the lookout for is that it doesn't start impacting on legitimate business transactions and causing taxpayers to pay a lot more tax than what they budgeted for. So what I do welcome is the withdrawal of the implementation of Practice Note 31. I think that was a very welcome change, but I can foresee some quite in-depth submissions to Treasury on the Annex C proposals that's contained in the budget.
Jenny, any final comments or insights from you?
I think, Charles, I echo Mansoor. I think we are going to have to make quite detailed submissions, particularly on the two-part retirement system. And I think the last point I want to mention is that there was an announcement last year that a discussion paper would be released by Treasury to do with remote working arrangements, home offices, and travel allowances. And we didn't see that happen last year. So there was another announcement in today's budget that discussion paper will happen in the course of this year. So hoping for some relief for taxpayers in terms of work from home arrangements. Thanks, Charles.
I hope we managed to unpack some of the detail, that you don't need to spend your evening reading through the details of Chapter 4 and Annex C. I think there are going to be some interesting developments. We were all very hopeful that this would be sort of a watershed moment, that we were close to the cliff and we would get it right. I'm not sure we did that exactly, but we'll stay close to it and watch things develop and help people implement the new structures as they get developed. So thanks very much for your time, and enjoy your evening.
Thank you very much. Bye-bye.
Thank you. Thank you. Bye-bye.